Circular 230 gives the rules for who may practice before the IRS and how tax practitioners must behave when representing taxpayers, preparing tax-related work, giving written advice, or dealing with client records and conflicts.
For REG, the main skill is identifying the practitioner's role, the rule that applies, and the proper action.
Okay, let's dive into this. Section 1. What this topic tests.
When we look at what this explainer covers for your CPA exam preparation, we really need to understand the exact mechanics of how these scenarios are going to be presented to you. The questions you'll encounter aren't just simple vocabulary checks. They're highly practical, and they're designed to test your professional judgment under Circular 230. You're going to be dropped directly into scenarios where you have to decide if a practitioner may act, must disclose something to the IRS or the client, or if they should just withdraw from the engagement entirely. To do this effectively, apply a strict 4-step deductive framework to every single multiple-choice question you face. First, who is the practitioner? Second, what exact IRS practice rule applies to their specific situation? Third, what action is either strictly required or strictly prohibited? And fourth, what consequence follows if the rule is violated? Examiners love to use this 4th step as a distractor to confuse you between IRS penalties and state board consequences, so really master this order of operations.
Moving on to Section 2. Who may practice before the IRS?
So before we can apply the rules, we obviously need to know who is actually authorized to practice before the Internal Revenue Service. Practitioners basically fall into 2 distinct categories. First, we've got professionals with full practice rights. This means unrestricted representation. Certified public accountants, attorneys, and enrolled agents fall into this group. They can represent taxpayers in all stages of IRS proceedings, and that includes audits, appeals, and collections. Second, we have limited representation rights. These are other qualifying individuals, like enrolled actuaries or certain registered tax return preparers. Their practice rights are restricted and tied strictly to their specific roles. Now, for your exam preparation, don't get bogged down in the granular, deep licensing details of those limited groups. The examiners are really just evaluating your broad understanding of who has ultimate authority. You just need to solidly grasp the fundamental difference between full unrestricted rights and limited rights.
All right, Section 3. Core practitioner duties. Once an individual is authorized to practice, Circular 230 imposes some fundamental behavioral standards. Think of these as the non-negotiable pillars of a practitioner's conduct. First is competence. You have to possess the necessary knowledge and preparation for the specific tax matter at hand. Diligence requires you to be thorough in preparing documents and making statements. You must ensure accuracy and prompt handling of all IRS matters, meaning no unreasonable delays. You're also required to make correct representations to both the IRS and your clients. Now, the concept of reasonable inquiry is heavily tested. If a client gives you information that appears incomplete or inconsistent, you absolutely cannot blindly ignore obvious problems. For instance, if a client claims a $50,000 business deduction completely out of nowhere and provides zero supporting documentation, you can't simply sign off on that return. You have an affirmative duty to make reasonable inquiries and ask the necessary follow-up questions to resolve those red flags before submitting anything.
Next up, Section 4, Client Records.
So, the crucial point here is understanding the exact protocol for handling client documents. The rule draws a really hard line between different types of records. Client-provided records, meaning the original documents necessary for the client to comply with their tax obligations, must be returned promptly upon request. Here's the vital exam angle you need to watch out for. Examiners love to paint a picture where the client owes the CPA $10,000 in past due fees, basically trying to make you sympathetic to the CPA. Don't fall for it. The client-provided documents must be returned even if there is a dispute over unpaid fees. You cannot withhold a client's records as leverage for payment. On the flip side, practitioner workpapers, which are the schedules and calculations you created yourself, belong to you. You're generally permitted to retain copies or the originals of your own work product, but those original source documents from the client, they have to go back immediately when asked.
Let's turn to Section 5, Conflicts of Interest.
When a conflict exists, there's an exact, methodical sequence of requirements you must satisfy to continue representation, and you cannot skip any of these steps. Step 1. You must have a reasonable belief that you can still provide competent and diligent representation to each affected client despite the conflict. Step 2. You must obtain informed written consent from each affected client. Examiners heavily test this specific requirement. Verbal agreements or a casual handshake mean absolutely nothing under Circular 230. The consent must explicitly be in writing. Finally, Step 3. If the conflict is unresolvable or if you simply cannot obtain that written consent from all parties involved, your required action is to formally withdraw from representation.
Now for Section 6, Fees and Financial Conduct.
And this brilliantly illustrates how Circular 230 places strict limitations on practitioner compensation and financial behavior. Reasonable fees are required. You simply cannot charge an unconscionable or exorbitant fee for your services. Contingent fees, which means charging a client based on a percentage of their refund or a specific tax outcome, are heavily restricted. In fact, they are strictly prohibited for preparing an original tax return. There are very narrow exceptions, like during an IRS examination of an original return. And why is an IRS examination an exception? Well, because at that stage, the numbers are actively being challenged by the IRS, so the ultimate outcome is genuinely contingent and subject to substantive review. Undisclosed referral fees or hidden commissions are strictly prohibited. You must communicate honestly without any improper financial arrangements. Lastly, refund checks carry an absolute rule. A practitioner is completely prohibited from endorsing, depositing, or cashing a client's refund check under any circumstances, not even into a firm escrow account.
Section 7, Written Tax Advice and Questionable Positions.
When giving written advice or evaluating aggressive tax positions, your written advice has to be fundamentally based on reasonable facts, reasonable assumptions, and a fair consideration of the law. Fair consideration of the law means evaluating both sides of an issue, not just cherry-picking the court cases or rulings that happen to favor your client's desired outcome. You can't simply take your client's unsupported word as absolute truth, nor can you rely on facts you know to be questionable. Furthermore, you cannot willfully ignore relevant tax authorities just because they weaken an overly aggressive position. On the exam, you need to evaluate the support for a position logically. If a position lacks a reasonable basis in fact or law, you have to make a firm decision regarding whether the practitioner should proceed, disclose the position to the IRS, correct the issue, refuse to sign the return, or withdraw entirely.
Moving to Section 8, Exam Scenarios in Action. Let's see how this works in practice. We're going to apply our decision framework to two simplified, realistic scenarios. Here's our first one. A client approaches their CPA to prepare their annual tax return. The client hands over a basic summary sheet and tells the CPA to just use this. But the CPA immediately notices that this summary clearly lacks the standard detailed schedules and backup information the client has always provided in previous years. The CPA has to pause here. Why are the details missing this year? Does this align with the duty of diligence? The required action here is that the CPA absolutely cannot proceed blindly. Because the information presented is obviously incomplete and inconsistent with prior years, the practitioner's duty of due diligence is triggered immediately. The CPA must make a reasonable inquiry to resolve these incomplete facts. A client's mere statement to just use the summary is definitely not enough to override the practitioner's federal obligation to ensure accuracy. The practitioner must ask for the missing details before even thinking about signing that return. Now, let's examine Scenario 2. A CPA is asked to represent two separate business partners who are currently under an IRS examination. The underlying problem is that the partners are actively blaming each other for the tax discrepancy that's under investigation. This is a classic conflict of interest scenario that you must know how to navigate procedurally.
The correct action is that the CPA must first make an objective determination. Do they possess a reasonable belief that they can competently represent both conflicting partners? And this has to be objective. Even if both partners are begging the CPA to stay on the case to save money, the CPA cannot proceed if they fundamentally believe competent dual representation is impossible. If the CPA objectively decides yes, they can handle it, they must then obtain informed, written consent from both partners to proceed. If the CPA cannot secure that written consent from both, or if they determine the conflict is simply too severe, the required action is to withdraw.
Finally, Section 9, Common Exam Traps.
Examiners design multiple-choice questions specifically to test if you'll fall for predictable psychological pitfalls. Let's rapid-fire through these carefully so you can spot them instantly on test day. The first trap is confusing IRS practice rights under Circular 230 with state CPA licensing. Remember, Circular 230 is federal authority regarding IRS practice. State boards issue and revoke CPA licenses. A question might ask who revokes a license and trick you into selecting the IRS. The second trap is thinking a dispute over unpaid fees allows you to hold client-provided records hostage. An MCQ might state the CPA placed a lien on the records. This is a distractor. Under federal tax procedure, client-provided records must be returned. The third trap is missing the word written in conflict scenarios. The question describes a conflict where clients have a great phone call and verbally agree to waive the conflict. Sounds resolved, right? Nope, it's a trap. Verbal consent is insufficient, it must be informed written consent. The fourth trap is assuming a client's bold statement is always enough factual support. If a client promises a highly unusual deduction is valid but provides zero evidence, your duty of reasonable inquiry overrides their promise. The fifth trap is treating all contingent fees as perfectly fine. An MCQ might say a CPA is charging a contingent fee for an original return. That's generally prohibited. Charging one for an IRS examination of that return, that's an exception. Recognize that difference. And lastly, the sixth trap is ignoring the need to withdraw. If a client demands you take a position that lacks a reasonable basis in law, the answer isn't to just document it in your files. You must refuse to sign or withdraw entirely.
Circular 230 questions become easier when you identify the practitioner, the IRS practice rule, the required or prohibited action, and the consequence.
For REG, focus on competence, diligence, records, conflicts, fees, written advice, and whether the practitioner should proceed, disclose, correct, refuse, or withdraw.